So two of my stocks had big dips in the share price yesterday, both of them down over 10%, and I'll talk about why those stocks are crashing and when I could potentially buy some more shares in them two stocks. So I hope you enjoyed the video. Let's get started. Now, even though two of my stocks were down big amounts, I was actually about break even yesterday, and the reason why I managed to get break even is because of this guy was having another fantastic day. Hims and Hers back on the recovery, up 13.15%, a very big move in Hims and Hers. And wow, it's a volatile one, isn't it, Hims and Hers? It is very volatile. I mean, in the last month alone, we're up 52%. But during that time frame, I mean, we've had some mega dips. I mean, we had a 10% dip at the start of May. If you look here, when the news came out about the new weight loss drug they had access to, we had a big rise, and then after that we had another drop of around 14%, and then from that time frame we've had another 20% rise since that time frame, and we are actually now higher than the news that we got on the weight loss drug, which is obviously pretty good. So Hims and Hers is absolutely flying. I mean, in the past year still up 115%, and year to date basically up 100%. So yeah, it's a volatile one. Anyone that has been able to buy and sell at the right time, you're doing quite well there. It's been a very volatile and day tradery stock there. And by the way, if you want to get a Hims and Hers poster, I think Hims and Hers is investable at $3.11, 13th of May 2022, Andy Pickering. If you want to get one of the posters, there's 50 of them limited. They're all going to be numbered, and I'll scribble JKR investing on them. There's only 50 of them, guys. They are going to hopefully arrive on Thursday, and I'll start sending them out for you guys. There is a couple left though. If you do want to get your hands on one of them, I'll put the link in the description. But getting on to the two stocks that are crashing. First one, Celsius. I'll let you know the other one actually. The other ones are going to be DraftKings. So we're going to talk about these two stocks, but I'm going to start with Celsius to start with. So Celsius was down 12%, nearly 13% today, and it was actually down a lot lower. If you look here, the stock was actually down 18% at one point, but there was a recovery in the last couple of hours and some buyers did start coming into Celsius stock. So what's going on with Celsius stock? So one of them is that there's been a few news stories going out about someone saying that energy drink sent them to hospital. I mean, this has been around for a long time. There's always a couple of these stories that come out like 6 days ago, 11 days ago. If I do click on that article, I don't actually have access to the article because I'm not from that region or something on those sort of lines. But basically the article, the guy that hospitalized basically blamed Celsius for it. But then he came out and said, oh, but I was drinking 2 or more every single day. And it was like, well, you know, it's one of those where it's a perfect example of why you go to McDonald's and you get a hot drink, and on the hot drink it'll say caution hot. Like, what do you expect? There's only so far you can go with a bit of like sympathy with people before you go, but what did you kind of expect? You know, it's like dancing around on the middle of the motorway and then going, oh, why did I get hit by a car? It's just one of those that sometimes these things come out, and all these people, you see them all the time, like Red Bull, and there's people drinking like 3 or 4 Red Bulls a day, and then all of a sudden their insides give up on them or explode, and it's like, well, you know, what did you expect? You know, it's like drinking 8 coffees a day, you know. So I'm not really believing any of this stuff that's kind of a few people are pointing out as something that's going on with Celsius here, so I'm going to go straight past that one. The big reason that I think Celsius did dip, and this actually ties in with information that came out today, not a few days ago, a few weeks ago, a few months ago, is some new data that came out. So the Nielsen's data came out and they showed a cooling of Celsius. So they do data, I think it's nearly every week, and it says what's doing very well and what's not doing very well. So they said that the pace has slowed. Now, when they say the pace has slowed, it has slowed to 39% for a 1 week period. Now, this is the big thing. This is a 1 week period. So in that one week period, there might have been a big promotion where Monster turn around and go, you know what, discount all of our products by 20% for this week. So 1 week is a very short period of time to be taking data from. But even if it's a 1 week period, 39% year over year, I mean, let's just call it 40%. 40% year over year. I mean, if that's slowing down, guys, I'll take a slow down rate at 39% a year. That's still very impressive, and I think that we'll still see Celsius grow 30+% for a couple more years yet, so I won't worry about that too much. A few people actually then posted out saying that the market share dipped from to 10.5% from 10.8%. Same again, like it's a 0.3% dip on a 1 week period. once again, Monster might have just gone, you know what, discount all of our products, they discount all the products, the sales go up and they also take market share. Look, on a long-term point of view is that Celsius is growing 39% year over year. That's more than, I think it's something like quadruple the category growth. You don't tell me they're losing market share, because they're not. When you're growing 39% year over year, you are not losing market share. So I think this is just a variation in the 1 week data. I think in the long term, there's no issue here at all with Celsius, and I think this has just got blown way out of context where people are panicking for no reason. And I generally can't believe that this stock has been sent down. At one point, it was down this much, down 18%. It's absolutely crazy dip, and I don't blame anyone for actually buying up on this dip. Now, personally for me, am I going to buy up on the dip on Celsius? Well, probably not. Even though the numbers are good, and I mean, look at the EPS growth. We're going to go from $1.09 to $1.09 from 0.77. Same again next year, up to $1.43, and we're still growing at 30+% year over year. I mean, the data is still very good from Celsius, and financially, if they keep moving in the right direction, it'll be absolutely amazing what Celsius does. For me, I've got a decent position, and for me, I wouldn't really want to buy Celsius unless it got really low. Like, at this point here, if it stayed around that kind of $77, $76, $75, that's where I might consider buying. I've got an okay position, and I don't really want to buy it 91 times earnings. I mean, it's going to trade at a premium, but even this is probably a little bit too much of a premium for me. I'd like to get Celsius more towards like 60, 70 times earnings. That's where I'd be happy to buy it. So personally for me, I didn't buy the dip, but I would if it got a bit lower. If we're talking like in the low $70, $60 range, you would see me buy. So I'm just going to wait on that one and see if it gets there. I don't think it will, but if you're really desperate to get a Celsius position, I would have said today was probably a good day to buy the dip on this drop anyway, because I don't think it should have dropped this much on this kind of news here. The next one was DraftKings. So my largest position took a complete whack today. It was down 10%, but like I said, I wasn't down that much because my second biggest position was up 13%, so it kind of balanced it out a bit overall, which was okay. But DraftKings was down 10%. I mean, if it wasn't down 10%, today would have been a very nice day in the portfolio, which is a little bit frustrating. But yeah, I mean, DraftKings, I think one of my predictions at the start of the year was that I believe DraftKings is going to have a softer year than last year. I think we all saw the stock go absolutely bonkers, and I mean, before the dip that it was on, it was up still 89% in the last year alone. I think my year-to-date prediction was DraftKings to be up less than 30% this year, and it is currently up 9%. I think before the dip here, it was up around 30%. So it's about where I expected DraftKings to perform this year. I think the financials just need to catch up a little bit now, which I think will be really healthy. So I'm fine with this. I'm not surprised to see DraftKings having a bit of a slower year this year. But obviously that was a pretty aggressive drop here. I mean, still, we're still up a lot on this position, 30, 40 something percent. I mean, Celsius, we're still up like 50+% on that position, and that's not including the profit that we took on when we used to own it previously as well. But yeah, a big drop today. Why was the drop? Well, the drop came because of Illinois, and they basically increased their tax on DraftKings, which isn't good. So the drop in Celsius, I think, was a big overreaction. The drop in DraftKings, I was like, oh yeah, I know why it's gone down today, to be fair. That is bad news. And even though the news itself wasn't financially that of a big impact, I mean, realistically, the news that came out today probably is going to cost DraftKings probably something like 20, 30, maybe 40 million in profitability. And it wiped off around about 2 billion in the market cap. So it's a big difference on the market cap to the actual impacts that it had. It's more the knock-on effects that might affect DraftKings. So what happened is they're basically going to increase their tax rate, and it's going to go from a range to 20 to 40%. The more income you bring in, the higher your tax rate you have to pay. Now, DraftKings is going to come in the higher rate. It's going to come towards the 40% tax rate, which isn't good. But the big thing is that Illinois came live in June 2021. In that time frame, they started doing a 15% tax rate. So going from a 15% tax rate up to nearly 40% tax rate is a massive jump in the tax, and obviously that will lead to less profit of DraftKings. So that's going to have an impact on the bottom line of DraftKings, and the big thing that we've always been looking for is the improvement into profitability. And obviously if you are getting more tax, that hurts your path to profitability. Now when it's one state, Obviously, it's not too bad, and that's why if you look at this state, you'd go, oh, okay, and not good news, but we'll move on. What everyone did today is they ultimately went, oh, well, if Illinois are going to do this, does that mean every other state's going to do this? And that was the big worry, and that's what caused the big drop in here. And that's, for me, that's the big worry that I have. My big worry with DraftKings has always been around the taxes and the rules that will be put around it. That's always been my worry. You know, people always talk about DraftKings, the profitability side of it. That's never worried me. People always worried about the potential growth, never worried me. People worried about ESPN Bet, never worried me. There's always been so many bears about DraftKings, and they've never worried me. This is the one thing that does worry me, because if every state does go to higher tax rates, it will hurt the profitability on DraftKings, and that's always been my worry with DraftKings. And I knew this day would come. I expected it to be 3-4 years more down the line than today, basically, is what I was expecting. Now, obviously, New York sit on a 50% tax rate, which obviously is very high, the highest one of them all, and DraftKings still operate there, and they must still operate there and make profit, because otherwise they won't operate there. So they can still make levels of profitability here, but it's just obviously going to hurt long term what the profitability could be if every state does it. Now, that's not guaranteed that every state does it. You know, that's the big thing, is that this is only one state. It's just that not a lot of other states might be going, hold on, if we can charge, you know, take another 20-30% cut, why don't we do it? That's obviously the big worry that we have here. So it's definitely something we need to watch. But the big thing that I would say is that these positives from this situation, even though this is something that I thought was bad news that came out today, and I looked at that and went, it's not good. There was a couple of positives with this news. So the positives is that when you look at Illinois, 90% of all online sports wagers came from DraftKings and FanDuel. So DraftKings and FanDuel basically have a duopoly, which, by the way, people said they would never have a moat. And DraftKings and FanDuel have basically a duopoly over the whole sports betting sector. So DraftKings and FanDuel own most of the market, basically, in the US. Now, when they control 9% of the market, the DraftKings CEO and the FanDuel CEO actually get on quite well. So if they keep seeing a lot of this happen and going, hold on, both of us contribute to 90% of your tax income. Hold on, if you don't drop that tax income in the next 6 months, us, FanDuel, we're going to pull out. And imagine if them two pulled out. Would they still carry on with that tax rate? Now, obviously the big problem is that if you had a segmented market, that'd be an issue, because then you'd have to get all the companies to go and, you know, agree to it. But when you're DraftKings and FanDuel, and both of your CEOs actually get on for rival companies, you know, you got to remember DraftKings and FanDuel were going to merge. They were going to merge until they got told they weren't allowed to do it because of the antitrust reasons. You know, if they own 9% of the market, I'm sure both of them, the CEO of FanDuel, which I forgot his name now, and Jason Robbins, you know, I'm sure they're on the phone to each other going, you know, let's both drop out here and let's you know, play a game of chicken, and let's see if they do follow this through. I think the ball's still very much in DraftKings and FanDuel's court when they have 9% of the market. So don't count that big factor out at the moment. And what I'll also say is that we currently have 38 states that are live. I think it's like 50% of the population. Imagine the rest of the states that aren't live at the moment. You know, all these states that aren't live, they're going to be looking at going, all of these states are making this tax money, and all these states like New York are even making even more money from the tax. Like, when are we going to do this? So even though it's a bit of an impact, what it could do is that they're seeing all these states that are collecting all this tax money, and the ones that don't allow online sports betting are surely looking there going, I think it's about time we allow this, because look at the tax that we're missing out on. So this might actually push other states to actually allow online sports betting, which would be good. And what also this pushes it to is that Illinois at the moment doesn't do iGaming. They only do sports betting. When you look at iGaming, we still only have 5 states that have iGaming at the moment. So what surprised me about Illinois is that I'm really surprised that they have increased the tax without doing iGaming first. Like, why didn't they do iGaming? Rather than going, oh, let's just make more money from these iGaming states, we can make more money from allowing iGaming, and then we get sports betting and iGaming, and I think, you know, they'll lose out on a lot of money from the illegal market. Well, let's actually make tax off it. I'm surprised they didn't allow iGaming, but what it will do is hopefully push a lot of these other states going, hold on, we make all this money from sports betting, why don't we start allowing iGaming as well, because we can make just as good money from the iGaming market. So What this could potentially do in as a positive is actually push a few more states to go, hold on, we're missing out on all these taxes, why don't we do it? And it might also push Illinois to go, we can't increase taxes anymore, but we can make more money from allowing iGaming. And then once again, what DraftKings will do is just drag and drop. Allow it in the state, they make more money. Put iGaming in the state, drag and drop, they make more money. And also from DraftKings' point of view is that when you look at the likes of New York, for example, they are able to manage New York. They basically go in and they basically, they give the states that have the higher tax rates the worst odds. And they said their argument is to these higher taxes that do come in is that they go, all right, you tax us more, but what's going to happen is we're going to give worse odds. And if you had better odds, you're probably going to make more from your overall gaming revenue because people are willing to go, oh, look at how good those odds are and do it. And you'd make just as much money from the lower tax rates. So that's the argument that DraftKings have. But even though they are able to kind of balance it out with the, offering worse odds in the higher taxing states, I think the big trump card at the moment does lie with DraftKings and Flutter that, they own 9% of the market. I think if they both wanted to, team up and go, you know what, you're dropping that tax rate or we're pulling out, I think that's a big ace card that they've still got up their sleeve if need be. So yeah, overall the news with DraftKings was not good news. There was a couple of positives in there, that potentially it would push other states to allow it maybe even quicker or maybe maximise their iGaming, but overall it definitely wasn't good news. I thought this day would come. I expected it to be maybe 3 or 4 years down the line when the market got a little bit more mature. So I think the big thing to look at is when the new states come online. If the new states come online and they choose the higher tax rate from the start, that's where I'd be a little bit worried. But if we start seeing some of the newer states come online and they're still starting with 20-30% tax rates, I think we'll be okay there. So we'll see. It's definitely something to keep an eye on. DraftKings, am I buying any DraftKings on the dip? No, not really. I'm already really fully allocated into the position. I don't really need to buy any more shares. I think if I am going to buy any more shares, you would only see me buying at like $25, something around there. I need to see it drop a lot more to buy it. I don't really need to buy it. I've already got a really good allocation. If I didn't own DraftKings, would I be buying now? Yeah, I might nibble a little bit. I think with a stock like this, you might get. I mean, realistically, from its all-time highs, it's only down 24%. I think with a stock like this, you could maybe get it down a little bit lower at times. So I'd maybe slowly nibble in it. If you thought you missed out on the party, for sure. But for me, I'm not chasing this just yet at these sort of levels because I mean it's still I think DraftKings has gone a bit more to a premium valuation. I think it's 80 times forward earnings now. So it's not cheap. It's like Celsius. So personally for me, I'll wait for it to be a bit lower, but I won't blame anyone for buying on the dip, for sure. So yeah, that's my thoughts on DraftKings anyway. So yeah, bit of talk on Hims and Hairs, bit of talk on Celsius, bit of talk on DraftKings. Hope you enjoyed the recap, guys, and hit the like button. Let me know if you're buying any Celsius or DraftKings on the dip as well. Let me know if you bought Hims on the dip as well. And apart from that, thanks for watching. I'll see you in a bit.